China has just taken the upper hand in a battle America believed it had under control. Scott Bessant demanded that Beijing give up its currency tactics, yet it was the US dollar that took the hit. Now American factories are suffocating under their own tariffs. Shipping traffic from China has dropped by 60%, and retail shelves in the US could be empty in just 5 weeks. As Washington scrambles, Trump is pressuring Britain to sever economic ties with China, only to be met with silence. Meanwhile, Beijing is thinking long-term. This isn't just policy anymore, it's economic warfare. So what happens when your most loyal ally stops following your script, and your top rival begins writing the next one? Bessant's push for China to keep a strong yuan, while hoping the US dollar would weaken, wasn't just risky. It may have been structurally flawed. Since January 2025, the US dollar index has dropped by nearly 10%, but instead of fueling a revival in US manufacturing, the drop has only worsened cost pressures across American supply chains still tied to Chinese parts. The tariffs Washington set up, some as high as 145%, were supposed to push China inward. But with key materials blocked and US industries still unprepared, the dollar's fall is now stoking inflation rather than boosting exports. You can't devalue your way through a supply shortage, warned Mark Zandi, chief economist at Moody's. In a recent analysis, he noted that limited inventories and rising import costs are combining into a perfect storm. Meanwhile, China's yuan has stayed impressively steady, slipping just 3.2% this year, a sign that Beijing isn't backing down. They're watching. And with global markets placing $17.2 billion in net short positions against the dollar last month, according to CFTC data, investors are betting Bessant's strategy is unraveling fast. Between January and April 2025, the US dollar index fell from 105.2 to 94.8, a nearly 10% drop reported by Bloomberg. The goal was to boost exports, but the result has been higher production costs for American manufacturers still reliant on Chinese imports. By contrast, China's yuan only dipped 3.2%, a big difference from its 14.5% plunge during the 2018 trade war. As Bessant argued for a stronger renminbi and a weaker dollar to rebalance global trade, Chinese officials moved carefully. The People's Bank of China cut its one-year loan prime rate to 3.35% in March, boosting internal demand while keeping currency volatility low. Now, the dollar's fall is benefiting Beijing. According to HSBC strategist David Bloom, a soft dollar with no strong U.S. industrial backup leads to stagflation, not export growth. China is now exploiting the contradictions in Bessant's plan, with patience and precision. U.S. retailers are trapped in a countdown they can't stop. As of April 2025, shipping volumes from China to key American ports like Los Angeles and Long Beach have dropped 61%, based on data from Flexport and Panga. The National Retail Federation and others have warned that inventories at major retailers like Walmart and Target will hit crisis levels within 5 to 7 weeks unless import levels return to normal. The reason? Tariffs. Duties now range from 75% to 145% on key items like electronics, car parts, and clothing. This has driven up costs across the board. According to UBS, the average cost of imported electronics rose 32% year over year, and furniture prices jumped 45%. Meanwhile, core goods in the Consumer Price Index rose 1.1% in March, the steepest monthly increase since 2021, highlighting how fragile supply lines are. Yet Washington keeps saying these tariffs are just temporary tools. If that's true, the clock is ticking, and loudly. Bessant's dream of a US-led global manufacturing revival missed one hard fact. America's industrial base isn't ready yet. According to the Federal Reserve's March 2025 Industrial Production Report, U.S. factory output shrank 0.6% month over month, and capacity usage fell to 76.8%. Both developments show that reshoring efforts are still far from catching up. At the same time, core producer prices jumped 1.3% in Q1, mainly due to higher costs for construction materials and imported machinery, both of which remain deeply tied to Chinese suppliers. The labor market isn't helping much either. The Bureau of Labor Statistics recorded a 17% year-over-year drop in U.S. manufacturing job openings this February. Without reliable supply chains, skilled labor, or scaled-up domestic production, a weakening dollar turns into a burden, not a boost. As economist Mohammed El-Arian put it during a Bloomberg panel, this isn't dollar diplomacy, it's dollar dysfunction, and the markets are reacting. In response, China's central bank has taken a calculated approach, using the dollar's decline as a chance to roll out selective stimulus while keeping exports competitive. Since February, the yuan has traded steadily within a narrow range of 7.19 to 7.25 against the dollar, even as the US dollar index dropped. That controlled range allowed the People's Bank of China to inject over 1.5 trillion yen, about $210 billion, into state-owned banks using low-interest lending tools, according to Kin. Meanwhile, exports remain solid. China's trade surplus for March reached $13 billion, driven by a 17% rise in shipments to ASEAN nations and Latin America, according to customs data. They're essentially buying time to shift growth internally without sparking capital flight, explained Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis. Beijing's approach isn't reactive, it's precise. By maintaining yuan stability as the dollar declines, China is managing to protect both its manufacturing base and monetary flexibility. The UK now finds itself caught between loyalty to US policy and economic self-interest, as Washington ramps up pressure to cut trade ties with China. Peter Navarro's April 2025 comments in The Telegraph, calling Britain a compliant servant of communist China. But the data doesn't support a fast decoupling. Cutting those ties would hit critical industries hard, especially electric vehicles. Chancellor Rachel Reeves didn't mince words, saying, "It would be very foolish not to engage with the world's second-largest economy." At the same time, the London Stock Exchange is reviewing Shein's IPO, despite bipartisan concerns in Parliament. Despite strong U.S. rhetoric, British leaders are pushing back. In 2023, UK-China trade totaled £62.60 billion, about 7% of all UK goods flow. The UK is also still courting Chinese capital. Shein's potential London IPO highlights Britain's divergence. A leaked cabinet briefing reported by The Guardian revealed internal resistance to U.S. pressure. In an April speech, Navarro warned, if the Chinese vampire can't suck American blood, it's going to suck the UK dry. According to the Rhodium Group, Chinese outbound investment to the UK actually fell 27% in 2024. UK regulators have also blocked Chinese access to nuclear and telecom sectors, including banning Huawei from 5G infrastructure. Britain hasn't surrendered, it's choosing its moves carefully, said Fiona Hill, former advisor to the U.S. National Security Council. The trade war is no longer about pure leverage, it's about narrative. Trump dealing with a Q1 GDP contraction of 0.3% and a 1.1% dip in real wages. Meanwhile, Xi is managing 5.3% youth unemployment and a property market that suffered a 22% drop. Behind every customs form is a campaign ad waiting to happen. Publicly, both Washington and Beijing say they're ready to negotiate. Privately, neither side wants to move first. A Weibo account linked to CCTV didn't hold back, saying, the U.S. must be the more anxious one. Treasury Secretary Scott Bessent told IAF attendees, there's a big opportunity for a serious deal if China really wants it. This kind of strategic uncertainty is a classic diplomatic method known as constructive ambiguity. To the world, it looks like two giants at a standstill. CFTC data shows $17.2 billion in active net short positions against the U.S. dollar, up from $9.8 billion in January. Bloomberg's dollar index has dropped nearly 10% year-to-date. The yield gap between 10-year U.S. Treasuries and Chinese government bonds has narrowed to just 32 basis points. This goes beyond just trade, said Morgan Stanley's Ruchir Sharma. The dollar is paying the price for America's lack of industrial readiness. China is letting the wind float gradually while rolling out a 1.5 trillion yuan stimulus. The same global financial system that once backed U.S. dominance may now be fueling its decline. What once looked like a two-country dispute is now reshaping into a broader, multilateral realignment. According to WTO figures, China's exports to BRICS countries rose 19.4% year-over-year in Q1 2025, while its exports to the U.S. dropped 31.7%. Meanwhile, internal EU trade jumped 12%, as countries started stockpiling and seeking alternative suppliers. The UK, caught in the middle, is pursuing two deals at once, one with Trump's White House and another with the EU. This is the real stress test for globalization 2.0, says Adam Tooze, Columbia historian. As nations weigh dollar-backed security against yuan-fueled affordability, alliances might not just shift, they could unravel. What's coming next may not be a new global bloc, but a complex web of trade loyalties. These decisions won't be shaped by ideology, but by inflation, wage costs, and shipping routes. The world isn't splitting apart, it's repricing. So let me ask you, who's actually steering the future of global trade? Governments or investors? Drop your thoughts in the comments. And if you're enjoying this, don't forget to like and subscribe. Stay tuned for more hot news from 3 Daily News.